Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. Today's video is a summary of my July 22nd energy update, in which I will explain why I believe natural gas has unexpectedly declined and why we believe we are near an important long-term buying opportunity. I focus on natural gas in my videos because it's the largest source of power for the generation of electricity. Therefore, their pricing is highly correlated. In our June 24th energy update, we said that based on what has happened since 2000, along with the three factors that were discussed in that report, confirmed that we are likely in the early stages of a cyclical bull market. The three factors discussed in the June 24th energy update were, first, producers responded to unsustainably low prices below the cost of production by making strategic decisions to curtail production to support higher prices. The Baker Hughes' most recent report, released July 19th, confirmed that producers intend to curtail their production, with active gas rigs down 21% from this time last year, declining from 131 to 103 active rigs. Secondly, increased exports of liquefied natural gas, LNG, overseas, and exports to Mexico via pipeline growth are decreasing our total domestic supplies, resulting in our present supply surpluses becoming deficits in 2025, which will support higher domestic prices long term. And finally, NOAA is predicting summer temperatures will likely be higher than normal throughout most of the United States, and AccuWeather is forecasting a very active summer storm season, which could lead to higher prices this summer. But as you can see from this chart, after writing our June 24th energy update, natural gas has declined sharply. In my introduction, I said I was not only going to explain why I believe natural gas has unexpectedly declined, but I will also explain why I believe the recent decline has presented us with an important long-term buying opportunity. But first, let me explain what precipitated natural gas's recent decline. Initially, the decline can be attributed to normal profit-taking after natural gas's explosive rally that started April 26th. It is normal for cyclical bull markets to experience profit-taking pullbacks periodically before resuming their long-term moves higher. But natural gas's recent decline accelerated when Hurricane Beryl made landfall in Texas and caused an outage at the Freeport LNG's terminals. The shutdown reduced our LNG exports, which increased our inventory surplus. The Freeport LNG plant is one of America's largest LNG plants and can liquefy as much as 2% of our daily natural gas production. Therefore, it is not surprising their shutdown is having a short-term impact on natural gas prices. But why do we believe we are near an important long-term buying opportunity? The unexpected closure of Freeport LNG has led to a short-term decline, but it does not alter the three long-term factors I discussed earlier. Therefore, I believe we are still in the early stages of a cyclical bull market. My approach in analyzing natural gas is to use the empirical evidence of past price patterns to guide my recommendations and explain why the patterns were formed. An example is since 2000, when prices were as low as they were this year, producers always responded to unsustainably low prices that were below the cost of production by cutting production, leading to cyclical bull markets. And as you can see from this chart, since 2000, when natural gas has trended higher at least 2.5 to 3 years, they were classified as cyclical bull markets, and they were always triggered by unsustainably low prices similar to where we are today. And as I explained earlier in this report, this year we have an additional factor supporting a cyclical bull market. Increased exports of LNG overseas and increased exports to Mexico will deplete our supplies here at home, which will support higher prices long term. The recent decline in natural gas was attributed to normal profit-taking within an ongoing cyclical bull market, which was unexpectedly extended due to Freeport LNG's temporary shutdown due to Hurricane Beryl's early arrival in this year's storm season. But it is important to note the Freeport LNG shutdown is a short-term event. while the long-term factors discussed in today's report remain firmly in place. Therefore, we recommend anyone with agreements expiring within the next 18 months take advantage of the recent unexpected decline to lock in rates lower than where rates are expected to be at least through 2025. We realize our clients' risk tolerance and hedging strategies are not all the same, but hopefully today's report will help put into perspective your risk-reward opportunities. And we invite you to call one of our energy analysts to help you plan a hedging strategy appropriate for your situation. And until my next report, please take care.